Oh my gosh, you guys, I just went to say good morning. Instead of good morning, good evening. So glad to see everybody here. We're excited to talk about this topic, and I'm sure your guys are excited as well. This is going to be something that you guys are not going to want to miss. So we're excited that you guys are here. We'll give a couple minutes to let everybody continue to filter in. Gary, always good to see you. Armando, oh man, it's so good to have you guys on tonight. We are excited. So I'm going to kind of dive in and let you guys know. Again, some of you may know who we are. Some of you may not know who we are. We are MF Capital Partners. We focus on the acquisition and the management of opportunistic and value-add multifamily properties. And we specialize specifically in repositioning the well-located assets in the emerging markets to protect investor capital like your own. And we want to provide the high yield returns that y'all are looking for. So how do we do that? Exactly what we're going to talk about tonight. We're going to talk about how we predetermine such a high level of success for our fund, and how we knew that the fund was going to be a success before we even announced the Akahi fund. So we're going to kind of share some of our strategies, some of our tactics with you guys, and we're going to do that for the next 30 minutes. We want to respect your guys' time, so we're going to make sure that we keep this webinar to 30 minutes. Now that we have the logistical out of the way, we've got Ryan Wally. Some of you know him, some of you don't. I actually am very interested in the chat. Those of you that do know Ryan, give me a thumbs up, kind of give me an idea of how many of you actually know who this man is. There we go. Okay. See, you guys know who this guy is. Yep. Well, either way, Ryan is absolutely the magician behind the curtains. He's the managing partner of MF Capital Partners, and he is truly the brain behind our acquisitions as well as our dispositions. So this man is really who we owe our gratitude towards for really getting our investors their returns and allowing us to have the track record that we've been able to obtain. So I'm excited to pass the time off to Wally as he explains how he does his magic.
Wooly, huh? Wooly, Melissa. It's funny. I haven't heard that since my days in high school playing baseball. So it's what my friends call me. I guess we'll be friends tonight, right? So
Ryan, do not tell them how long ago that was. We have to keep them thinking that we're young and hip.
Well, that's just simply not the case. So no, it's a pleasure to be on here. I'll tell you this. For those of you that do know me, I'm surprised that Melissa didn't say this and make fun of me. But I sent a picture out on social media today and had a root canal earlier today. But it's so important to me to get on and talk about the Akahi fund and more importantly the MF Aloha funds. We've done a lot of great things in our track record, as Melissa said. It's not one person; it's a whole collective team of us that have gotten us to the point of really a 37-38% annual rate of return for a track record. That takes a whole team of us to be able to do that. And so, as we go through, kind of who we are, and who the MF Aloha Fund, for those of you guys who have been on a webinar, it's no secret that we, Melissa, can you actually see that, the MF Aloha Fund? My technology skills, my Excel skills are great. My technology skills, maybe not so much.
Y'all, that's where teamwork comes in. I got your back.
It's teamwork, right? It's teamwork. So, I didn't know if it was the drugs from the surgery, but listen, it's working. So, it's no secret that we like to talk about the MF Aloha Fund, right? We always talk about, we own an education company and an investment company. We're always talking about opportunities to passively invest and where those opportunities are at right now. And so for us to be able to create the MF Aloha Fund, has just been a great thing. And Melissa, if you can help me, I don't have my chat up right now, but if anyone asks any questions, that way I can see it. Actually, I can pull it off to the side here. But who is MF Capital Partners? For those of you that don't know, and this is your first time here, MF Capital Partners is led by Tyler Devereaux, managing partner, and myself, Ryan Woolley. Both of us got involved in real estate at the age of 21. There's no coincidence behind that. Just 21 years of age, we knew we wanted to be entrepreneurs. We knew we wanted passive opportunities. I came from a single family background, being able to flip it in my 20s and had some success there. But really, I gained my knowledge from my grandfather. I grew up at a young age of seeing my grandfather have wealth, right? Being able to passively invest and actively invest in real estate. And when he passed away, he left a legacy. For many of you guys on this call right now, you're looking to leave, something. You're looking to gain something, right? I mean, right now, there's no secret that 401ks are taking a bloodbath. Mutual funds, bloodbaths, cryptocurrency. My goodness, I almost wish we didn't have it in crypto. But man, am I sure glad that we have just a shitload of money, right, in our properties, right? I mean, with a track record of 37%, right, we've made some really good money. Those of you who attended other webinars, we exited a lot of our portfolio out of the South Carolina region and did extremely well. We averaged a little over 37% on that one, and in fact, one property was close to 46%. Some of you guys were on this call that were able to participate in that. Those were phenomenal returns. So, but we're led by really our team. I wouldn't say it's Tyler Devereaux. It's more of who our team is. As you can see right here, we're led by a lot of these, amazing individuals. You see, lo and behold, Melissa right there on the top left. You see Jackson Campbell, who's on it. He's a fund manager amongst the, Todd Miller, who oversees our financials, Tasha. And a lot of you guys have been able to talk to Tasha and Melissa on a regular basis. We also have underwriters. We have people, a lot of people say, hey, listen, you got to a fund level. Who do you have on your team, right? Who's helping you get there as you grow more, right? As you're able to take down all these properties, who's going to be helping you? As you can see here, we have asset managers, acquisitions, underwriters that we're working with on a regular basis, to help us get there. But a little bit of what Melissa said is, where are we at track record wise? If you're going to be investing in a fund with us, it's important to know who we are, what kind of our track record is. Our total portfolio right now is $391,640,000. And hey, by the way, if I talk too fast, tell me to slow down, and I can definitely slow down. If you can understand me, maybe put some thumbs up. I definitely want to be understood. So, our total unit count is 3,706 units so far. Matthew, thank you so much. But our annual rate of return, like I said, our track record is right around 37%. So many of you guys, you've asked, why invest with us, right? You just got an email, about some topics. I want to make sure that we cover those topics. One of them is the clear, signs. The 5 properties we had in the Kahi fund, how are they working, right? How are they doing right now? That was one fund. Okay, if I'm going to invest in the MF Aloha fund, what types of deals are going in there, right? More importantly, how are these deals doing over here in the fund, and why did you create a second fund? I want to be able to go over that for you guys. How the MF Aloha fund, one of our first properties that we're acquiring, when are we closing on that? Those are questions that you guys have, and those questions as passive investors we have, right? When are you going to close on that deal? And then the sneak peek of deals that we're actually looking at right now. So I definitely want to make sure that we go over those for you. And like Melissa said, if y'all have any questions whatsoever, throw those in the chat area, and I want this to be interactive. We're going to go quick.
So wait, one of the best questions that we've gotten so far is, can Ryan sing the alphabet backwards since he's on major drugs for the root canal? I think that's the most important one.
I'm sure there's a lot I can do. Doing the alphabet backwards is not one of them. Knowing my strengths and weaknesses for sure. So, really quick, I want to go over Coventry Park, right? Here's a deal that, a lot of individuals, as we started to see some decline in the economy and approaching recession periods, this is a deal that we closed July 13th of this year. And a lot of people were questioning us. Hey, listen, you're seeing the market starting to decline. Do you want to hold off? And believe it or not, there's a lot of individuals who started to hold off. And we said, there's holding off, or there's identifying the correct property, right? One of the great things that I've learned through Tyler and the rest of the team is solution based, right? We want to always look at solutions. We don't ever want to stop our growth. We want to look at the right deals, right? And so part of what I do in the company is I underwrite deals. I like to take a look at, why deals, some of the investors that are on here know this about me, why a deal won't work, right? why the deal won't work. I'll look at it 40 different ways of why a deal won't work. Why? Because I have to answer to you, right? I have to look at these underwritings and identify not only where we're at acquisition, but where we're at year after year, right? You know, as we talk about growth and growth opportunities, a lot of you have asked us, how do you exit? How long do you hold on to these properties? And I'm proud to say that our track record, right, of 37%, right, we haven't held a property longer than 2.5 years. Melissa, I don't know about you. I know that you passively invest individually as well into our deals, but being able to, you know, in a couple of them that you did were right around 12 months, right? How does that affect you and your family?
Oh, it's incredible. It's the unexpected, right? We weren't expecting it for much longer than that, but the ability to have a return in such a short amount of time, you just don't get that anywhere else.
Absolutely. Absolutely. No, I love that. You know, and a lot of people ask, you know, how are you guys able to do that? You know, a lot of these deals that we looked at they're mismanaged, right? You know, there's sellers who didn't, you know, they didn't plan accordingly. Well, they probably didn't underwrite 40 times, right? Let's be honest, Melissa, you know, but, you know, they didn't plan accordingly. One of the biggest things that we believe in is 3 phases, right? We like to take down deals and we like to stabilize them when we get into them, right? At the same time, we may be able to execute the second part of the phase a little bit sooner. And you'll see that in some of these properties where we were able to do that. You know, I'm a big golfer. If there's any golfers, you know, on this golf, I'm huge into golf, right? You know, Saturdays are moving days, right? That's moving day on the PGA Tour. You know, and I like to look at the second, you know, phase is the value add period or moving day, right? How quickly can we move to be able to execute either a refinance or a sale of a property? You know, and then when the third part we have is, you know, analyzing the exit period, right? Are we going to refinance or are we going to exit? You know, I love Noelle. She put down golf because I know she's in Southern California. She's a big golfer. So, Noelle, I'm sure you're surprised I remember that. Anyway, you know, on Coventry, we acquired this property at 85% occupancy. You know, some people may look at that in the time that we're in and the market declining of going, why? Why would you acquire a property at 85%? There's a lot of things that go into that, right? We want to look at the demographics there. We want to look at the community, right? We want to look at, you know, market rents there. We want to look at comps. We want to see who the management company is. We want to get with our management company and identify some of those key factors, those KPIs that we go over, right? And identify, can we get those up? Well, I'm proud to say since July, you know, we've got that number up from 85.83%, right? I like to go into the hundreds there, Melissa, into the hundreds, right?
I'm going to call you a nerd.
A nerd, right? I geek out on this, but to 91.31% or a 5.48% increase, right? I want you to think about that right now. A lot of people go, hey, what are you doing with inflation? How does inflation affect me? And how does it affect my investment when I invest, right? Not if, but when I invest in the MF Aloha fund, right? When I invest into it, how does it affect me? Guess what? When inflation goes up, occupancy goes up, right? Well, we're in a good place if we can get rents up as well. So I want to go over that in the next one. Is rent growth is up since July, 5.63%. Melissa, 5.63%. Or what? What's that next thing say? Or $51. So I want you to think about that. Our first year, we identified the property at increasing by 3.5% on this property. 3.5%, right? In just a short amount of time. Melissa, do the math for me. Since July, how many months has that been?
July, August, September, October, 4 months.
Almost 4 months. Almost 4 months. All right, 3 months. But hey, that's all right. 3.5 months. It's okay, right? $51 increase, right? Because when we went into this market, we looked at the rent rolls. We noticed that a lot of these units were expired or month to month. And we said, awesome. If we can go in and we can improve some things really quick, right? We can execute our plan a little bit faster than what we normally do, right? And so, you know, with that being said, you know, we're well ahead of our performance without even renovating anything, without even tapping into our CapEx budget. You're seeing right now a lot of these properties that people are selling off is they haven't truly identified what their CapEx budget, or they blow through their CapEx budget. I want you to think about this. I said there's 3 phases. The second phase comes, right, in value add. And in value add, your CapEx, right? That's when we're going to tap into our CapEx. Usually on the first part of stabilization, it's anywhere from 6 to 10 months. We want to stabilize the property for 6 to 10 months to make sure that the occupancy is healthy before we start ramping up and raising rents, right? If we can do it sooner than that, which you've seen on this, we've been able to do, right? Then we can do that. But we've been able to do that without even tapping in to our CapEx budget. So I want you to think about that. The longer we hold the property, the more financially healthy we are as a business, right? As this investment is a lot more financially stable. I may stumble over my words, right? Obviously, surgery the same day doesn't.
We'll forgive you.
So the rent may go up, but what about the tenant's capacity to pay in a recession? Liliana, great question. Great question. We typically don't do the whole property, right? We typically don't do every single building. We typically start out with one building, go to the second building, and then all of a sudden tenants start to talk, right? But more importantly, we truly believe in our property management company to establish relationships, right? And ask questions, right? We send out newsletters, right? We have them, we have our leasing agents go out and talk and see what's going on. We're looking at seeing what's going on in typically a 2 to 5 mile radius, right, of what's going on with rents. We really dial it into a microscopic, area, really 2 miles to see what's going on. So we're making educated decisions, Liliana, on if we can raise those rents or not, right? But we truly believe is this, right? When you make an apartment community a home, right? When you make it a safe environment to live in, right? A lot of times if there's not in there, we'll put lights in, right? Security floodlights. We'll put security cameras in, right? Typically in an entrance, there'll be a video camera right there, right? Who typically, I'm gonna ask a question on sidetrack here, but Liliana, you can answer this if you'd like, or anyone else. Who typically is a person who is the deciding vote, right, when you rent? Who's the deciding person typically in a family, right, that makes the decision? I'd love to know that.
Everyone knows the women make all the decisions.
The mother, yeah, I love it. Typically the mother, right? Mother first, right? Father's going to decide if they can, typically afford it, right? I don't want to say gender stereotypes, right? Because that's not the case, right? But typically in a family setting, a mother, right, is the nurturer and will make that decision in our experience, right? And so they're going to make sure that safety comes first for their family, right? Safety first. Men, right, we look at the price, right? Really, women look at safety, right? It's usually how it works. But on this property, right, is Liliana, we're able to go in and fix the community up. We're able to go in and identify some things we want. One of the things that the tenant said on this area right here is, they wanted us to improve the landscaping. They wanted a playground in there, right? So those things right now, we're already looking at getting bids, as we speak, on improving those areas. As they see, as we ask questions, right, of the tenants, and we respond in a way, right, that fills their needs and their wants, right? What are they willing to do when we increase rent? They're willing to pay it, right? They're willing to pay it because they are in a safe environment, and they're in a fun environment. Do you expect the exodus as you are increasing renting? Is yes. Well, what is typical? Yeah, I mean, typically, you'll see 5 to probably 8% of people that will leave, Yanni, on that. But not always, right? Not always. Here's the thing, in market rents, we're going to go in, on this specific property, we were already below market rent, so we're able to go in and increase those numbers, right? A lot of the properties, and you'll see one of the properties we're identifying right now that will close at the beginning of December for the MF Aloha fund is $300 below market rent. When you do that and you're that far behind, this property is about $250 under market rent. So when you're able to increase that fast, right? The reality is typically apartments in those areas, they'd have to spend $200 more, right? Most of those owners in there, right? They're going to take it to market rent. So even if they move somewhere else, right, they would have to pay a higher rent anyway. So for them, the deciding factor is community and what are you going to do to improve. So for us at the very beginning, it's important to ask those questions. Awesome. So let's go on to Dover Point. Dover Point is also one that was in the Kahi Fund. 168 units. We acquired this July 27th, 2022. I'm going to be honest with you. Hopefully you can hear me. My face is numb, Melissa. It's numb right here. So, you know, it's a miracle that that this is speaking like this. I don't even
I'm
know
not
if it's
gonna lie.
there.
I really wanted you to have like a droopy face. I know I was
Yeah,
probably a terrible person for saying that, but I really did. I wanted you to, but you sound
natural
great. You look
smile.
great. Can't even tell.
Natural smile out of my mother's womb, right? Natural smile. So awesome. So July 27, right? 2022, occupancy up 5%. You know, I want you to see a pattern here as we go through this, right? Typically out of the gate, right? In the first quarter, right? We talk about stabilization. We're able to find these properties that are mid 80s, right? And we're able to get them into the 90% within a quarter. But why is that? It's the relationships that we have with property managements first. And during our due diligence period in acquiring a property, we're asking the right questions, okay? We're asking the right questions, and you'll see that on one of the properties we're looking at right now. In fact, I saw Marichelle on here. Good to have you on. You know, this property we're doing with Marichelle. So, you know, it is, you'll see that we're asking the right questions during the due diligence process of how quickly they can get to those points, right? So our rent growth, I want you to think about this in move-ins, right? Yana, you asked this question in the Exodus, right? On move-ins on Dover Point, we're already up 7.51%. Because I want you to think about that. We're hitting almost 2 year, our second year pro forma numbers in the first 3 months, right? We're already hitting there. In about 6 months, we'll have already hit our 2-year numbers. I want to rewind it, Melissa, a little bit. I want to rewind here, right? So I want you to think about this, right? How long in the chat do we typically in our previous deals, not saying that's going to be all of them, in our track record, do we hold on to our properties for? Typically about 2.5 years is the longest one. 2.5 years, right? So how are we able to do that? We have a plan, like I said, during the due diligence phase, right? So that when we acquire the property, we already have that plan and we're implementing the property. More importantly, I want you to see this right here, the third bullet point, okay? We're saving our CapEx until stabilization, right? We're doing these things without even putting money into these units, right? Simple turns, right? Simple cleaning of the carpets, simple cleaning of the hardwood floors that are in there, right? And we're able to go in and stabilize a property into the 90 percentile, right? And once we do that, then we can increase the rents like we want. The last bullet point here is collections, right? You're seeing a lot of things, Yana. I think that you're maybe hitting on it. You didn't ask the right questions, or you didn't ask this question. Sorry, you asked the right questions. You just didn't ask this one. I'll adjust your question on the loan at 86%. So collections are up 5%. I want you to think about that, right? These tenants that aren't paying, there's typically reasons of why they're not paying. They may be in a bad position, you know, with their job, right? Typically, they can't stand the management company or the owners of those properties, right? And so, you know, when they come to hard times, they're not going to pay it. You know, something I've learned in my experience, and a question that we ask our property management companies: how do you treat your tenants, right? Do you treat them as a number or an individual? Do you know their names, right? Do you know their names that come in? One of the properties I'll show on here, it was quite interesting. We just went and looked at it in Dallas, Texas, at Arlington actually, but we went in there and there's some tenants that came in, right? 616 units, some tenants came in. They've had this property for 3 years, right? This property management company, Melissa, was awesome. They knew the names of the tenants that came in. They knew the names, right? And so what does that do? They know their stories. They know who their kids are, right? They know who their partners are, right? I think it's so important, right? That as we're able to do that, as we're able to get this in, right? It's not, hey, we go acquire a property because, you know, the numbers are awesome. We've got to be aligned with who's looking out for our properties, right? Who's the one that's there on a day-to-day basis, you know? And so, you know, collections being up 5% is huge, right? Huge on this property. So I want to jump into Glenwood, little baby unit, 60 units. But I tell you this, MF Capital Partners has killed it on smaller units, just killed it, right? You know, but this one, we're up 4%. We just acquired this, you know, end of last month. End of last month, my gosh, time flies by so fast, Melissa.
It
so
does.
fast. You know, but we've already, in just a little bit of month of time, right, because of our relationships with our management team, 93 to 97%. Right, 93 to 97%. How huge is that? Okay, we can't really do a whole lot in a month's time, right, with the rents. So one of the numbers and one of the stats that we look at are our 90-day numbers, right? Renewals, right? Renewals are who's staying. You talk about attrition and who's leaving, right? You call it the exodus, Yaniv. But the 90-day renewal period, we start at 90 days. Where are the decimals? Oh, Steve Martinez, I knew you were going to give me crap for that. Right? Yeah. I was waiting for Melissa to give me crap on that one.
I was going to be nice.
90-day renewals, right? So we like to go out 90 days in advance, right? And start getting individuals in. In fact, we have these things, right? And Marisol, you see this on our properties. We call it the wheel, right? We spin the wheel, right? You've seen Wheel of Fortune, right? I love that show. It probably dates me, right? I mean,
Definitely.
Wheel of Fortune was like, anyway, I'd love to watch the show. So we have this wheel, right? And you spin the wheel on one of your renewals, and you could get a fan, you get a coloring in your, in your apartment, right? I mean, it may be upgraded flooring. It may be, just different things that we put on there. I want you to think about those three things I said, right? What are those things to a tenant? They're upgrades, right? But what do they are, to us as owners and investors, right? It's value add, right? It's an increase to the property, right? Which is going to make them happy and make us more money, right? And that's the goal, is to be aligned in both areas, right? Make you guys more money, make us money, right? In the Ikahi fund, we put $750,000 of our own money in, right? And on the MF Aloha fund, we're going to put close to that as well, right? We want our money to work alongside you guys, in addition. So the 90 days, we're up 8%. 8%. Unless I want you to think about that, right? As renewals renew, right? This is, once again, almost our 2-year number, right? Our 2-year number. Okay. In the first year, we like to hit about 3.5%, 4% in rent increases. And then we jump in to roughly, depending on the market, roughly anywhere from 4 to 6%. So what you think about that, right? As these individuals renew in about 4 to 6 months, we're going to be at our 2-year number should these numbers continue, right? And our trends, as our track record, show that they do continue because of some of the things I said we do. New move-ins, so those were renewals at 8%. Our new move-ins right now, because of our community, because when people come and they come onto our properties, what are they doing? They're asking other tenants, how do you like it here? How's the property management company? What are they doing, right? I mean, our management companies do so good. We have incentive programs for them always, right? We'd love to give money, out to them when they're doing their job, right? Not only does that make them happy, it's a waterfall, right? It goes down to the tenants as well, right? But the average move-in right now is about 9% in increases already, right? And increases already. Once again, hitting close to our 2nd-year numbers, right? More importantly for me, as I underwrite and I'm looking over your money, your investments, right? It's important to me that, if you've ever invested with anyone else, you see these operators, right? You see these owners that go out and they blow all their money out of the gates. They just blow their money away, right? And I think, how irresponsible, right? How just financially irresponsible, right, is that, right? I'm not going to go take all of my money and throw it into a property right away. And you may look at that and go, well, why not, right? It's going to get my rents up. Well, there's a reason, right? There's a system that we have, right, that has allowed us to be able to achieve, a 37% annual rate of returns for our investors, is to be able to save it, right? Do everything we can to the property, slowly, right? Increase rents, increase those numbers without having to always spend, right? We may spend in the exterior. We may do simple little things like that, right? But we want to save our money and see what we can do to kind of move the needle, right? To move the needle. We always want to make sure we have a buffer, right? So that we don't ever have to come to, I'm proud to say we've never gone to our investors for a capital call, right? Meaning, if you don't know what a capital call is, that's when you run out of money and you have to go to the investor and say, hey, we need more money to execute the business plan because we screwed up, right? Or because the property took more money and we didn't underwrite it correctly. That's a position that we've never put ourselves into, and we hope never to have to do that. But it's because we've been responsible out of the gate of how we handle our money. Awesome. Well, I must be explaining this all right, Melissa, because I haven't seen any questions outside of decimals. And
Absolutely.
Exodus.
And I was going to say, Ryan, it's a perfect example of when you guys are vetting operators, it's a perfect way to really identify that they are being conservative, not only in their projections, but in what Brian just explained? Are they actually being conservative in really raising rent?
Yeah, I take a look at that, and it's conservative is a great word, right? It's a great word. Some people want to be aggressive. Now, I've never seen the corny little thing as a kid, right? The tortoise or the hare didn't win the race, right? The tortoise did, right? We like to try to be the hare and the tortoise, right? Conservative, maybe that's a dumb analogy, and if whatever, right? I'm gonna give that.
That's where teamwork comes in.
I get a hall pass today on analogies. I get a hall pass. So, yes, you can definitely, Noman, you can definitely get the presentation afterwards. I would love it. And once again, I do a poor job at this, but listen, anytime you want to hop on with the investor relations team, right? Obviously, we get on these because we're so passionate about what we do, and we have the MF Aloha Fund, right? There's a lot of you guys looking to invest, right? And you know that you want to invest, right? You're just looking for operators that you can trust, right? And that you can invest with them with security. And more importantly, you just want to know, like you said, Melissa, we passively invest in other deals that people come to us and say, hey, do you want to invest? But we vet them out, right? We want to see what their business plan. One of the biggest things is, how do you spend your CapEx money? That's one of the biggest things for me as I passively invest, is how do you spend it? What are the questions you ask your property management company? Who's managing the property? Definitely questions we ask. Here's a property right here where the previous our seller, as we acquired this end of last month. They ran out of their CapEx budget, and I tell you, it's sad to see, right? It's such a beautiful. You can see just a beautiful property. I was just out there last month with Tyler, and we were taking a look at just beautiful. I mean, absolutely beautiful. I remember looking at it, I go, holy shit, we own this property. Literally, it's on both sides of the street, man. It's beautiful, beautiful, and the tenants are happy. I mean, so happy there. Like I said, this is the property that the existing management company has been there for 3 years, and Teresa is the manager, of the on-site manager. And I tell you, she was so amazing. Just greeted us at the door. How's it going? What can I do for you? Tenants came in. Hey, Cindy, how's it going? What are you up to? How are the kids doing? It was just amazing to see, just the transition of how they just treated the people compared to other properties we've been at, and how managers treat them, right? But this property right here, I put the stat on there. They ran out of their CapEx budget. And so they were forced to sell, right? They were forced to sell. Well, we're in a market where rates went up, right? And if they refinance it, they're not going to get as much in proceeds they need to. So we were able to negotiate it down. This is about a 7-month purchase. Anyway, we ended up purchasing it for $85 million, right? When it appraised for $97 million. LPs. Right, 37% annual rate of return, Yossi, for the LPs, right, as a passive investors. Definitely, great question. And Melissa, you can stop anytime you want to explain some of those. How often do you not spend all CapEx budget? I'll tell you, most of our properties, Steve, I'm proud to say that we have CapEx budget still at the very end when we sell the properties, right? And what's that mean when we have CapEx at the end? It all goes back at the return, right? Your return on equity, it goes right back to you guys. So awesome. So what you think about this? The Akahi Fund, when we were able to go in and negotiate some of the prices and go in because of the state of the economy that we're in, right? We the original purchase prices were $151,900,000. We went in and we acquired these properties at $136,040,000. So I want you to think about what that does for you. We all know that real estate's it goes in cycles. Stock market goes in cycles, right? Crypto hopefully will go in cycles, right? But, real estate, we always know it goes in cycles. My grandfather at a young age, I was on a webinar, last month with you guys, some of you guys, and, we saw what happened in the 70s. We saw what happened in 89, 97, 2008, right? We're seeing what's going on today. Everything's in cycles. Typically, the 2 years after when the market started to go down, right? Whether you agree we're in a recession or not, you can't change what the definition of a recession is, right? I won't get into politics, but you can't change it. It's been that way forever. It's been that way for a long time, right? GDP growth, right? It's stunted over the last little bit. It is what it is, right? Recessions are okay, but typically in each of those years I just said, the 2 to 3 years afterwards is where most of the people made their money, right? Most of those people made their money during that time. Yeah, Andres, great question. Doing a lot of bridge debt, right? Here's the thing. There's two types of bridge debt, right? There's fixed rates and then there's adjustable rates. So we're very, very cautious when we get into loans of how much, how many adjustables. We'll buy that rate down and get into a fixed rate, right? Meaning what? We're going to put more equity into the property, right? And not leverage, right? We're not going to leverage, and we're not going to take way before 3-4 years ago, you were able to get 75-80% leverage. Today, it's really 60-65%. One of our properties, we did it at 56%. What's that mean? Right? That's a lot of the buy down, right? A lot of money down, up front, but which means more of the equity, right? Not as much in debt service that we have to pay or a mortgage. Some of you guys, might know that as, and so it puts us just in a better place that way, right? Different approaches as well on that. It's a great question. But how much equity did that create within the fund already, right? As we know that cycles are going to change and it's going to bounce back, we're really at what we call buyer's phase one, right? There's 4 phases. There's a buyer's phase 1, buyer phase 2, seller's phase 1, seller phase 2. We just got out of a seller's phase 2, right? It was a killer market, we call it bullish run, right? Where, properties were selling at just crazy amounts, right? We were able to benefit from that in our South Carolina properties, right? A lot of our investors, they invested in the Kahi fund because of the exit there, right? They did quite well. So 15,860,000 is what we've created already in the property. So what's that mean? Don't screw it up, Melissa, right? We just don't screw it up, right? But we don't coast, right? What we're doing is we're going exactly what I showed you, right? We're trying to get to that second year number, third year number, so that we can get to the fifth year number by year 2 and identify, hey, listen, are we going to refinance this or are we going to sell it, right? That's what we like to look at. One of the properties that was in South Carolina, we talked about, this is right at the beginning of COVID, right? When everyone said, don't buy properties. Some of you
we have a couple, we have a couple investors that invested in Tropical Bridge.
That are on the call, that are on the webinar.
Yep.
Yeah. Just think about this, right? Everyone's going to always say it's not the right time to buy, right? It's not the right time to invest, right? Listen, this is right at the beginning of COVID. I'm sure if you're an investor that was on here, you probably thought, should I invest, man? COVID, people aren't going to pay their rents, right? They don't have to do that, man. Listen, that was a lot of investors thought that, right? And it's no different right now, right? A lot of you are going, hey, listen, there's a recession. Maybe I should hold off on my money. I'm taking a bloodbath. Maybe my 401ks or mutual funds will bounce back. Sure, right? If you want to do that. We all know that real estate's always been the wealthy, right? They've always got it from either being an active or a passive investor in real estate, right? That's where people generate their wealth from. But we did this anyway. We did this deal. 18 months later, it was one of those moments where we told some of the investors who wanted to hold back and not do it, like, look, right? It was a 73% return in 18 months. 73%. We put 200 grand in and I sit there and think, holy shit, why didn't we put more money in, right? Hindsight's always 2020, right? Hindsight's always 2020. I cracked my tooth, right? I waited quite some time. I won't tell you how long I waited, right? And the dentist said it to me today. She goes, man, Ryan, I said, man, if I would have come in earlier. And she goes, yep, hindsight's always 2020, right? And it's the individuals, right? In 2009, 2010, people are picking up properties or picking up real estate going, shit, why didn't I invest in 2008 when everyone else was that was making the money, right? These individuals that invested in Tropical Ridge made a healthy return. Getting into the second point, I want to respect your time. And if you guys have any questions, would love to answer those as I finish up here. But one of the properties we're identifying right now that is going into the MF Aloha Fund will close in the first week of December, right? We want to try and close a little bit sooner. We just got done with due diligence. On that, like I said, first week of December, we want to close. But more importantly, the average rents are at about $900, right? $900 right now. But the market is at $1,200. I think, Yana, you asked that question earlier, is, are you going to see an exodus, right? Are you going to see an exodus in this? No. Listen, I know this area. I live 15 minutes from this area, right? Love to see that this is in my own backyard, right? It's in my own backyard, right? It's in Marichel's own backyard, right? She's one of the partners on right now. And Melissa, it's right by you as well, right? About about 20 minutes from you. But the thing is what I love most about this property is the amount of money that the city is pouring into this area, right? They're revitalizing this community. They're revitalizing this area, which means what? They're putting money in to improve the area around it, right? So they improve the area around it, brings better demographics in. It brings in better individuals, better tenants into these areas, right? And so the fact that we're $300 below market rent, right? Awesome. How old? How many units? Right? 140 units, built in 1985. So this property, right? $900. I want you to think about and go back to the properties that are in the Ekahi Fund. I'm like jonesing already, right? Because here's the thing: we're already meeting with AMC, who's our property management company, and going, what is the plan, right? What is your budget? Here's our budget, and what are you gonna do? I want you to think about this, right? We're in October, the end of October. We're gonna close the first week in December, and what the heck? We already have a plan, Melissa. We're already meeting with them to get a plan, right? I want you guys to think about that. You know, the plan now is how we're gonna execute it then. It's not the plan that we get after we acquire the property. It's the plan that we execute today, right? To be able to execute it when we take over, right? That's how we're able to move ahead a lot faster, because we're all aligned in what we want to do, right? You know, and so that's one of the properties we're looking at right now. I want to tell you about the other property, okay? We're looking at another property that's right across the street from Coventry. Once you want to talk about the state of the market, right? Do you believe that prices are coming down? Are prices coming down on properties, both residential and commercial? Yeah, absolutely they are, right? Absolutely they are. So this property right now is 172 units. It's right across the street from, well, kind of right across the street from Coventry. It's an off-market deal. We purchased Coventry at 105,000 a door. 105,000 a door. This property right now is 85,000 to about 90,000 a door. We're negotiating with them right now of what we're gonna do. Hopefully we win. Hopefully the negotiating skills, as you saw in the Ekahi Fund, right? We did a pretty good job at negotiating. Hopefully we get to the 85,000 point. A lot of you guys say, hey, why the fund? Why do you do the fund? Well, we're able to go in, identify properties we want. We're able to put down a little bit more earnest money into it, right? Because they see how serious we are and that we want these properties, right? So we're able to win and be able to negotiate on the purchase price. Why? Because they want to know that you have the ability to close, right? The ability to close. That's what's important to sellers, right? Not that, hey, you're going to get into it, which we're seeing a lot of, right? We have attorneys coming to us, lending brokers saying, hey, this is falling out of contract. Why? Because people aren't able to raise their money, right? They're not able to get the loans that they want. You know, for us, we plan and we prepare ahead of time to be able to do those things. So being able to put more earnest money down, right, allows us to get into properties for a lot less. I want you to think about it, a lot less. So a lot of you that ask why the fund and why not just a typical syndication model, that's one of the reasons, right? That's one of the reasons. So I want you to think about this. That property, if we bought this 172 units at the price we bought Coventry, is $3,310,000 less, right? Which means what's that to you? Right, that's $3 million.
Money.
Money. That's what Melissa likes to go, hey, Ryan, can we send our checks out, right? We sell the property, right? Hey, can we send checks out? Yeah, absolutely, right? We like to look at this. A lot of you look at it and go, what are you acquiring? I go, hey, yeah, that's great. Acquiring is awesome. I look at exits, right? I spend more time looking at my exit and what I can do and potentially what's going on. I talk with lenders. I talk with brokers. I look at what's going on with the Federal Reserve. I try to identify politically what's going on, right? And what's happening. There's a lot of things that come into play, right? When we're identifying exits, right? That's what I love. For me, I don't focus more of the initial side of underwriting. I focus more on the forecasting, right? What's going to happen and all the different variations of things that can happen so that we can get that $3.3 million, right? When we go and exit the property. So once again, you guys ask, how have you been able, I see someone said instant equity. Some of y'all, ask, how are you able to sell in 2.5 years? Well, it's acquiring properties like this. It's acquiring properties where if we do everything right, and we go in and we create a good community, that we have instant equity, as Steve said, right, of 3.3 million. Now we still have to do our job, right? We still have to exit correctly, right? But we're able to exit with good returns for our investors, right? So I want you to really think about that. One of the biggest things for us is this, right? The managing partner, Tyler Devereaux, he lives in Hawaii. We were trying to come up with a slogan, that best fits us, right? It was invest with Aloha, right? And I thought the logo looked great, right? But when he told me what the meaning behind it was, right? It means invest with purpose, right? It means invest with purpose. There's a reason why we invest, right? I've had a lot of friends that have lived in apartments. For hell's sake, I lived in an apartment in my early 20s with friends, right? And to see that individuals didn't take care of properties, right? Vowed if I ever got into that position, like my grandfather taught me, Ryan, you take care of others, they'll take care of you, right? Not expected, right? Melissa, you always talk about it's unexpected value, right? The unexpected value. As you take care of others, this is my grandfather, he passed away in 91, right? He's the one that passed away with millions and millions of dollars, right? He said, if you take care of others, they will take care of you, right? You know what you think about that? When you invest with purpose, right? You invest with Aloha, right? Not only are you putting money into these communities and entrusting us with your investment, but knowing that we're going to go into these properties, we're going to fix them up, we're going to create a good community where people are proud to live there, right? All at the same time, getting you guys a good return on your investment, right? And that cycle, someone said today, one of my mentors says, the circle of life, right? I thought it was funny. He has 3 little kids. I'm sure he watched, The Lion King, right? But it's a circle of life, right? As we continue that cycle, right? As we continue to do those things, each of you on this phone call today are investing for a reason, right? You're wanting to invest. You jumped on here, not to hear me talk, not to hear Melissa talk, right? You may like looking at Melissa. Listen, that's great. Mark, one of our investors, Mark likes looking at Melissa. That's great, whatever, right? But she doesn't do the Zoom calls anymore. But anyway, the reality is this, right? Is each of you are on here for a reason, right? You're here for a purpose, right? Your investments, you're looking for opportunities, right? You're looking for operators such as ourselves. They're going to put your money to work where you can make good money, right? You can make a good return on investment, but your purpose is making sure you're helping other people out, especially during a time like right now, right? So we'd love to open it up for any questions, Melissa. But I will say this, I'm glad I was able to speak 47 minutes, right? Ibuprofen.
I'm impressed.
Ibuprofen's a good friend, right? So, I'd love to answer any questions that for those of you that have any questions, but we're excited for you to join us, in the MF Aloha, right? We're going to be investing over $500,000 into this fund ourselves. And how that work? I know, Melissa, you're putting some money in as well. And so would love to answer any questions you guys have about the Aloha Fund or for some properties we're looking at.
Absolutely. And honestly, you did a great job of answering questions as they came up. So John just asked, can you invest without being an accredited investor? For this opportunity right now, it is only open for accredited investors, but we do have opportunities often that are not accredited. So John, we can make sure to continue to keep you updated, but this opportunity is open to accredited investors.
I would say, John, schedule some time with them. Tasha's put some links in there to schedule time. Get on the phone with them and ask them the questions you want.
Absolutely. Yep. And I want to address one of the questions where I can't remember exactly who it was, but they asked about the 38% annual rate of return. That is I want to make sure we kind of touched on how being conservative with your CapEx budget, being conservative with your market rate. That is one way that we as operators want to make sure that we are continuing to under promise and over deliver. So that's extremely important to us. We may have a 38% annual rate of return average, but we still want to make sure that we can over exceed any of your expectations. So like Ryan said, we would absolutely love to jump on a call with you, explain our track record, go into more detail about the properties or what you can expect with the Aloha Fund. Feel free to make sure that you don't miss that opportunity to catch Tasha and I. So John asked,
Jan have asked a question of how soon do investors start to see their returns?
You want me to answer that? Our distributions will begin 3 quarters after close. So it'll begin in Q3 of next year. That's when the first distribution will be sent. And John, the 37%, we haven't done a refinance. That's when we've exited the properties. I think that's all of it. That's all of the questions. Y'all, thank you so much for jumping on. Again, if you have any questions, make sure to let us know so that we can hit those topics. That's something that we're extremely passionate about. We want to make sure that we're addressing the topics and concerns that y'all have. So feel free to send us some of those reviews, and make sure to jump on a call with Tasha and I, and we can make sure that we get those topics answered for you. Again, thank you so much for spending your evening with us. We hope you guys have a great night.
Hey, Melissa, really quick, I want to answer that one quick. Jan asked, is the pref accrued? Absolutely it is. Right? If you're not seeing it, definitely accruing all the time. Yeah. from the day one we acquire the first property, right, is when your investment starts to accrue. Great question, Anna.
Absolutely. And Ethan, I'll go ahead and put my cell phone in here for you so that you can have my contact information. Feel free to reach out.
Hey, Melissa, I'm gonna let you close it out. I've got to get off and rest my mouth. So
But wait, first, Ryan, thank you so much for jumping on. We're so grateful for you to be willing to come on and share your wisdom, especially when you're in pain. We're so stinking lucky that this man's willing to do that. So thank you so much. Go get some rest and some caffeine, most likely. No monsters, though.
Thanks, guys. Hey, pleasure being on. Thanks so much, guys. Appreciate it.
Thanks so much, you guys. We'll talk to you guys soon.